Most retirees believe they know the rules. They've spent their whole lives working, filing their taxes, staying within the law. But something is happening right now in 2026 that almost no one is discussing. The IRS has quietly put a new enforcement system in place that is blindsiding smart, honest people. Not con artists, not career tax cheats stashing money offshore. Ordinary folks, people just like you. And the penalties are enormous. We're talking $10,000 for a single error, a single transaction you might not have even realized could be an issue. Now, before you assume this is just another doom and gloom money video, stay with me. I'm not here to frighten you into purchasing a product or signing up for a subscription. What I am going to do is lay out what's really going on, why it affects you, and most importantly, what practical steps you can take about it. Because here's the part no one explains. You don't need to hire pricey attorneys or CPAs to understand this rule. You just need to grasp one core idea. And once that idea is clear, you're shielded. You're secure. You're back in control. Let me begin by explaining what sets 2026 apart from every year that came before. The rule itself hasn't changed. The IRS has monitored large cash movements for many years, but the way they're enforcing it now, the technology behind it, the speed at which they can spot patterns, that's what's brand new. And that's the real story, not the rule itself, but how it's being enforced. For the past 4 decades, the IRS followed a familiar process. Whenever you deposited or took out more than $10,000 in cash, your bank filed a report. Those reports went into a government database. Sometimes someone reviewed them, sometimes no one ever did. The system moved slowly. It depended heavily on people. If you deposited $15,000 in cash and didn't list it as income, there was a reasonable chance no one would ever connect the dots. The IRS just didn't have the capability to track this efficiently on a massive scale. That all shifted in 2026. The IRS introduced new artificial intelligence tools. These aren't basic software programs. They're advanced algorithms that can match up your bank activity with your tax filings, your social security data, your property records, everything. They're hunting for discrepancies. They're running automated checks. If someone puts $20,000 in cash into their account, but their return says they only earned $18,000 for the year, the system flags it. Not a person, but a machine. And machines don't get exhausted. They don't overlook trends. They operate nonstop, every hour of every day. But here's where most people misinterpret this. The IRS isn't primarily out to trap you in a mistake. Their real target is tax fraud, people deliberately concealing income. The challenge is that this system is so aggressive, so automatic, that innocent people get swept up in it too. And that's where the threat really lies, not in intentional wrongdoing. The danger lies in the gap between what the software thinks is happening and what is actually happening in your life. Let me walk you through a clear example. Imagine you're a 72-year-old retiree. You receive a pension. You collect Social Security. You have some money in savings. 1 month your roof starts leaking and repairs are going to run you $25,000. You head to the bank and take out $25,000 in cash. Maybe your contractor prefers cash. Maybe you feel safer having it physically in hand. However you do it, it's completely legitimate. It's your money. You earned it. You already paid tax on it. But here's what happens behind the scenes. That $25,000 withdrawal gets picked up by the IRS's new system. The algorithm notes that you pulled $25,000 in cash. It then compares that to your tax return, which shows you had $80,000 in income that year between your pension and Social Security. The software asks, hold on, this doesn't line up. Where did this $25,000 actually originate? It's scanning for income that hasn't been reported. It's suspicious, and suddenly you're on the IRS's radar. In the past, that kind of flag might have just sat in a database and never gone anywhere. But in 2026, that flag launches an automatic inquiry. The IRS mails you a letter. They want proof of the source of those funds. And if you don't respond properly, if you can't produce paperwork showing that $25,000 came from your own savings, your own after-tax money, you could be hit with serious penalties. Not because you broke a law, but because you couldn't demonstrate that you followed the law. This is where the true risk lies. It's not that the rule itself is unreasonable. It's that the responsibility has shifted onto you. In the past, the IRS had to prove you did something wrong. Now it almost feels like you must prove that you did everything right. And that's a totally different playing field. Another big change in 2026 involves something known as structuring. And this is where things become genuinely confusing, because the way structuring laws work goes against common sense. Structuring means intentionally chopping up a big transaction into smaller pieces specifically to avoid triggering your bank's reporting requirements. So imagine you want to pull $30,000 from the bank, but you realize that taking $30,000 at once will generate a report. So instead, you take out 3 separate amounts over 3 weeks, $999.99 each time, all under the $10,000 threshold. You think you're being practical. You think you're sidestepping annoying red tape. But in reality, you've committed a federal offense, an offense that can carry the same $10,000 fine, sometimes more. The strangest part is that structuring is illegal even if the money itself is totally clean, even if you intended to declare it on your taxes, even if you had zero criminal intent. The very act of splitting that transaction on purpose to dodge a report is what breaks the law. The IRS treats that behavior as evidence of guilty intent. They assume you're concealing something. And these new automated systems are built specifically to spot those patterns. They can instantly detect when deposits or withdrawals follow an unusual sequence. They highlight it right away. There's no human officer weighing the situation, no presumption that you meant well. Here's what distinguishes people who avoid trouble from those who end up paying penalties. It's not random luck. It's not only about having a skilled accountant, though that's useful. It's about recognizing what the system is programmed to look for and making sure your financial activity doesn't accidentally resemble someone trying to hide money. Because that's the heart of this. The system doesn't evaluate your motives. It evaluates patterns. And if your pattern looks questionable, you must be ready to prove that it isn't. The upside is that this is much easier than it sounds because there are very clear steps you can take immediately that will almost completely protect you. And these steps don't involve expensive professionals or huge fees. They involve something much simpler. Being organized, keeping documentation, maintaining a clear paper trail, and knowing what triggers the system to begin with. That's what we'll get into in the next part. Not just what the rule says, but how to operate within it. How to make sure your finances are crystal clear to the IRS's automated tools. How to be prepared so that if a letter from the IRS ever shows up, you can respond calmly and confidently, knowing you're covered. Let's break down what actually sets off the system, because understanding the trigger is the whole game. Many retirees think the trigger is straightforward. You move $10,000 or more in cash, the bank sends in a report, and that's the end of it. But that's only a partial picture. The real trigger, the thing that creates real trouble, is when the IRS system spots a conflict between what it sees in your bank activity and what it sees on your tax return. Look at it like this. The IRS's AI is essentially asking a single core question about every big transaction in your account. Does this add up? Does this transaction match the income I see on this person's return? If the system's answer is yes, then there's no issue. You're fine. The transaction is recorded, stored, and forgotten. Life moves on. But if the answer is no, if there's a gap, if something doesn't line up, that's when you've got a problem. Not necessarily because you did something unlawful, but because you can't clearly explain it. Let me walk you through some real-world style scenarios. These aren't theory. These kinds of situations are happening to retirees right now in 2026. Scenario 1. You're a 74-year-old widow. Your husband died 5 years ago. When he passed, you received a $200,000 life insurance payout. You put it into savings. You've relied mainly on your pension and Social Security, so you've barely touched that money. Then one day, your daughter calls. She's in a crisis. Her marriage is collapsing. She needs support. She needs $40,000 to hire a lawyer and rebuild her life. So you move $40,000 from your savings account over to her checking account. You're supporting your child. That's what parents do. That's what families are for. But here's what the IRS's system observes. A $40,000 transfer leaving your account. Your tax return for the year shows you had $72,000 in income from pension and Social Security. Where did the $40,000 come from? The software has no context. It flags the transaction. And now you must provide proof that the money came from your own savings, from that life insurance settlement, from years of careful financial planning. If you're unable to show that, you could get penalized. Scenario 2, you're a 71-year-old retiree. You own a rental property, you sell it. The buyer is a cash buyer and pays you $150,000 in cash in exchange for a small discount. Totally standard in many real estate deals, you take that $150,000 and deposit it into your checking account. The bank immediately sends a report to the IRS. But here's the complication. Your tax return lists the sale price as $140,000. Why? Because you still haven't filed the updated return reflecting the exact final amount. That extra $10,000 hasn't been recorded yet. The IRS system sees the $150,000 deposit. It compares that to the $140,000 on your return. The numbers don't match, it flags it. And now you're stuck trying to justify a difference that exists solely because your paperwork isn't fully updated. Scenario 3, and this one comes up all the time. You're a 73-year-old retiree. You've got a pension, Social Security, and some savings tucked away. One day your car breaks down. The repair bill is $8,000. You don't want to put it on a credit card, so you go to the ATM and withdraw $8,000 in cash. A week later, your water heater fails. That's another $4,000. 2 weeks go by and you need new glasses and hearing aids, another $2,000. Over roughly 3 months, you've pulled out cash 5 different times, totaling $14,000. None of those withdrawals individually passes the report threshold, but taken together, they form a pattern. And the IRS's new system detects that pattern. It sees someone taking repeated cash withdrawals that add up to a big total. It raises the question, is this person structuring? Are they intentionally staying just under reporting levels? Chances are you're not. But the software has no idea. And if you can't detail where that money went, if you can't show how you use that cash, you're exposed. This is the single most important distinction between people who stay out of trouble and those who don't. It's less about whether you did something wrong and more about whether you can show you did everything correctly. Documentation is what separates safety from penalties. Now, here's where a lot of people misunderstand things. They hear documentation and picture complicated bookkeeping. They think it means elaborate spreadsheets, hiring professionals, building a huge filing system. That's not necessary. Documentation is actually very straightforward. It's a receipt. It's a written bill of sale. It's the invoice from the roofer who repaired your home. It's a simple gift letter from your child saying they gave you money. It's a bank statement that records a wire transfer. These are everyday items you likely already receive. You just need to store them in an orderly way. Let me give you concrete examples of what good documentation looks like in different situations. If you take out cash to pay for home improvements, save the contractor's invoice. Save the payment receipt. Take and keep photos of the completed work. That's documentation. If your children give you money, ask them to write a brief note. On December 15th, I gave Mom $20,000 as a gift to help with medical costs. This was my own money, and it was a gift with no requirement to pay it back. Have them sign and date it. That's documentation. If you sell an item, keep a simple bill of sale. If you move money between your own accounts, hold on to the bank statement showing the transfer started from an account in your name. If you receive an inheritance, keep the will, keep the executor's statement, keep the bank paperwork showing the transfer of inherited funds. These are all normal documents. You probably already have many of them. The only change now is that you need to keep them neat and easy to locate. Here's the second key point. Your tax return has to present the whole picture. If you receive an inheritance, your records should clearly reflect that. If you get a substantial gift, it should be documented. If you sell a property, that transaction needs to be correctly and fully listed on your tax return. If you go through any major financial event, you need to ensure there aren't missing pieces, because it's those missing pieces that set off the system. Missing pieces are what generate questions. Missing pieces are what result in penalties. The third key point is communication. If you're planning to move money in a way that's out of the ordinary for you, something that doesn't fit your normal pattern, talk to someone first. Speak with your tax professional before you act. Speak with your bank. Just a short conversation. I'm going to be withdrawing a large amount of cash for home renovations. I want to be sure it's all properly documented. That brief discussion signals your intentions. It shows you're not hiding anything. It shows you're being careful and responsible. And if the IRS ever inquires, you can point back to that conversation. You can say, I consulted my tax professional at the time. Here's what they told me. Here's what I did. That's protective. That's powerful. Finally, and this matters a lot, the system is engineered to identify deliberate dishonesty. If you're truly doing your best to follow the rules, if you're being truthful, if you're keeping records, if you're checking in with professionals, you are very likely in the clear. The system is not primarily aimed at people like that. It's built to catch those who are actively concealing, those who structure transactions on purpose to dodge reporting, those who are being deceptive. So here's the core takeaway from this section. The true trigger is not the transaction itself. The true trigger is the gap between what the system observes and what it can confirm. Close that gap. Keep records of everything. Ensure your tax return is thorough and correct. Communicate with professionals.